Well, good evening and welcome to this live stream on the 5th of March 2024. It's Martin North here from Digital Finance Analytics. Great to have you on this evening. And we're going to explore the markets and what's been going on and what might be going on over the next little while. Some interesting times, I think, and some degree of uncertainty probably as well. So worth exploring. And I've got Damien, who will come in just a second. Just before I bring him in, as normal, let me just remind you that we don't provide specific financial or legal advice. This is the general conversation only. We do moderate the chat, but feel free to throw your questions and comments into the chat. Feel free to discuss whatever you want to discuss there, but just be mindful of politeness, etc., etc. This is as of the 5th of March 24. If you're watching in replay, if you'd like to ask Damien or myself a question, please use at Walk the World. That will mean that I see it in the queue and it will get to my attention. The reason for that is that we get so much going on in the chat that I quite often will miss stuff unless it's actually specifically addressed to me. I've also enabled Super Chat, which means that if you'd like to get your question top of the list, you can do that, or indeed make a contribution to what we do around here. Always greatly appreciated. We do this not because we want to make a profit, but because we think this is a really important conversation. But nevertheless, the support that we get from our community enables us to do what we do here. So it is greatly appreciated. Right. Now let me bring Damien in. Damien, hello. Welcome back.
Martin, how you going?
Yeah, pretty good. Yourself?
Yeah, not too bad. Too bad. It is, I think we cracked 30 today for a change. So yes, I think it's very different to you, obviously. Yes.
Yeah. Well, we've been knocking around the, the zeros to fives over the last few weeks, but we had a sort of a patch of warmer weather and then it's back to winter. But what was interesting about the snow was it came literally overnight. So I woke up one morning and there was 3 inches of snow, and 2 days later it had gone. So, it was a short amount. Not like in the middle of winter when it sort of hangs around a bit. But look, there's some really interesting times talking about the financial weather and the market weather. And I suppose we should probably start with the Magnificent Seven, right? Because the Magnificent Seven have, gone to the moon. Oh, well, 6.5, the Magnificent 6.5, perhaps.
I think a lot of people started to call it 6, yeah.
Yeah.
And arguably, you could sort of argue it's 3 or 4.
Yeah. Well, and just to give everybody a bit of a view on that, if we were to look at, this is the NVIDIA one, which is 852, massively high, 40 times PE earnings, and I guess the question is, what is this doing? What is this AI-driven, narrowly based thing doing to the markets? Because of course the overall markets are quite extended, right? We're hitting highs, but it is really ultimately driven from this particular source. Yeah. So how do you sort of think about that?
Yeah. So I mean, it's interesting. NVIDIA. So 40 times. That's probably last year's earnings, I'm guessing. I think you sort of pull it back to it's below. It's probably around about 30 times, maybe a little bit lower terms next year's earnings. The interesting thing with NVIDIA, is that it's not that expensive given how much growth it's getting out of it. So that's the positive. And it's pretty clear the future is here earlier than I think most people expected. The question is whether the future is going to be better than expected. So if that makes sense. So they're going through this sort of exponential growth line where they're just racking up 20-30% gains in profitability and even more, doubling and over some quarters in terms of their profitability. Now the question is, does that peak? Does the fact that that's come earlier, does that mean the peak's going to be higher? Or does that mean actually, no, it's just this has come earlier. So that's one part. The next part then goes the amount you need to assume that they've got sort of 90% market share in this area of the market. And so you've basically got to assume that they're going to keep that 90%. Nobody else is going to break into that, and that the boom's going to get even bigger in terms of what's needed. So already you're looking at sort of figures where they're sort of taking is it 40%, 40 to 50% of all the new spending on data centers is sort of forecast to be going into NVIDIA. And so and just to put that in perspective, a data center, you need the land, you need the power, you need people to plug all the stuff in, you need the cooling systems, then you start needing the computers, and once you've got the computers, you need the networking, you need hard disks, you need memory, you need, all these things that NVIDIA doesn't do. But then you get to the sort of the GPUs and things like that they do, and because that's so valuable, and so there's this question then about can they keep spending at the rates because in the end it's data center spending that's going to do this. At the moment they're getting margins that sort of people haven't seen before, but they're getting margins well above what traditionally you'd see in this sector because everyone wants their stuff and they want it so quickly. So the question is, as the factories start to come online and as they can build more of these things more quickly, and they get some competitors, if you lose that premium pricing because of scarcity, and if they go from, say, 90% market share or 95%, whatever they are at the moment, back to, even 70 or 60% market share, so still the dominant player, but just not owning everything, then the numbers all of a sudden don't make as much sense. So yeah, it's really, can they hold on to this extreme leadership position and keep going with it? And I guess to put it in perspective as well is, if they had their own factories and they were making these, they're making the chips themselves, I'd have more faith that they can keep a higher market share over time. Because the thing is with is that they don't actually make these things. They've designed them and they're giving them all to either TSMC or Global Foundries and others to actually do the processing. So somebody else comes up with a design that is better than theirs, or even not even better, just needs to be 80% as good and half the cost, then that person doesn't need to go and build new factories and test everything. TSMC's already got the factories ready to go. And so, yeah, so that's the issue in terms of what's really driving this is that, they've got market leadership, they've got premium pricing, they've got this great growth. Can they hold on to all of it? And if so, then today's prices are probably all right, but maybe even a little bit cheap. If they pull back to, say, normal margins that you'd see in that sector. So over the next 5 years, if you pull back to normal margins and they end up with a 60 or 70% market share in that space, then they're probably going to look quite expensive at current levels.
Yeah, and I've been around long enough to remember the run up to the dot-com bust, right? And I remember at that time people were saying, things are different now. You can't use the traditional ways of assessing the value of stocks. You've got to be looking at other things, blah, blah, blah. And I remember Scott Manili from Sun Microsystems, he sent a message out to some of his shareholders and saying, look, you've got to understand at the valuations that you're giving me, you're assuming that I'm going to be able to grow much, much more significantly ahead than I think I can do, right? So and that was based on, I think, 10 times earnings, right? So there's an interesting question as to how revolutionary this is. I know AI is revolutionary at one level, and the productivity gains are probably real. But it does feel
is
to me
the person who makes the chips. Is the person who makes the chips? Are they the one who's going to get all the benefit from this?
Yeah,
and everyone else is going to. And you're like, no, they're not.
Yeah. No, and other players are going to be able to actually bring chips and GPUs in, and so you'd have to say that we are probably in an unusual situation with those. And you made the point. It's not really 7; it's about 3 or 4, right? And in fact,
let's go through them. We won't go into them as much detail as that, but let's deal with them all because they are all very interesting, I think.
Yeah.
In their own right.
Great. Well, let's do that. Yeah.
So Nvidia's. So sitting in Nvidia. Now their main customers. This is the other interesting part. Is the person who's selling the chips is one of these boom stocks. The other boom stocks are the ones who are buying the chips, and that's your Amazon, AWS, and AWS in particular, which is their web services part, Microsoft, Google, and to a lesser extent, but certainly still in their Meta. So they're all out there. They're buying. So what do you? Let's sort of deal with each of those individually. The other stock that's been booming is Meta. Now that's been a big holding in our portfolio, and the story still sort of adds up to me. So really what you're looking at for Meta is this company that's spending billions of dollars on the metaverse, which is effectively a 3D version of the world. Their assumption is that we went from text-based things to adding pictures and everything like that to lots more video and YouTube and on Instagram and all those things. And the next step is going 3D. And so if you look at Meta, it's sort of trading on 20-ish times, 20 to 25 times multiples, depending upon how you want to measure it. But the thing is, they've got this big millstone around their neck, which is they're spending all this money on the metaverse and not making any profit at all from it. And so the question is, if you pretended that was zero, and just said, okay, they're not spending anything on the metaverse, what's the rest of the business trading on? And it's trading on 15 times, which is sort of 20% below the US market. It looks dirt cheap at those rates. And so then this question about how do you value that Meta? Is that actually going to turn into something? Or at one stage, if you argued if they close the whole thing down tomorrow, the stock all of a sudden looks really cheap. But maybe this investment will turn into something big. So anyway, that's your Meta argument. Google's got lots of AI itself. It's got some, ad spending's we think coming off a little bit, but generally speaking, there's still this switch from ads from old media to new media. And that's sort of in that 20 to 25 times as well, about market multiple, maybe a little bit more expensive. So it's not, it doesn't look terrible on that basis, and growing relatively strongly. It's them. Microsoft and on Google as well. They're sort of second place in a lot of the AI, the actual real AI, which is actually generating the actually having something that generates the responses for you. Question marks on why they're not better, I guess, is certainly out there, but they're in the running with it. Microsoft is your other big one that's growing fast. Now they're a lot more expensive. That is our biggest holding, and we're starting to wind back on it. Look, great steady earnings. We think they've put up prices, and they're probably going to stick with it. They're probably one of the types of companies that are probably going to hold on to more of the prices that they've put through. They've got great growth in their cloud computing. They've got great growth from AI. There's a potential that maybe they'll actually pick up some more search if OpenAI tends to be, proves to be a reasonable competitor to Google. They might take some of Google's market share there. They've got a lot going for them. The only thing is they're really expensive, and it's a really big company. And so even if you do have, some of the AI and things like that doubling and tripling, because they're such a small part of such a huge company, they don't have as much of an impact. So love the company, looks expensive. Not going to go to zero, but certainly we're pulling back a little bit on that at the moment. Tesla is seeing lots of earnings downgrades. There's a huge price war going on in China at the moment in EVs. It really doesn't look that positive. There's a pretty decent argument that a number of manufacturers are making is that cars are really hard to make, internal combustion engine cars are really hard to make. And you got to design the whole thing around this engine that's effectively a controlled explosion, and there's lots of stuff you need to do with it in terms of engineering. Electric vehicles are a lot simpler to make, and Foxconn, which is one of the world's biggest manufacturers of mobile phones, effectively put together all the Apple phones. They're making a big push into cars, into electric vehicles, because they look upon it in a similar way. It's just putting bits together. And so, there's a reasonable amount of argument around Tesla about, how much do they really have? And in particular, are they worth more than every other car company put together? So, that's that was who have I missed? I missed somebody. Oh, Amazon. So Amazon is Amazon's fascinating. International division loses money, always lost money. So how much do you value that? Who knows? You could value it at zero, call it 100 billion, doesn't really matter. The company's so big, it's, whether it's 100 billion or zero, it's a rounding error anyway, and their overall margins. They've got the AWS, which is Amazon Web Services, and that is a rocket ship. It's been doing 20 to 30% growth for years and years and years in terms of earnings per share. It's where all their profits come from. They make 50, 60% margins in it. Great business. That's where heaps of the value is. And then you've got this huge US online shopping company, which has made great sales growth and just tiny, tiny, tiny squeeze in margins. And the margins are so small that sometimes they lose money, sometimes they make lots of money. They have these big swings around. And all of a sudden, in the last couple of quarters, they've been making margins that are well above most other retailers. And so now, are they going to keep trying to make money? Are they going to decide suddenly at some stage they want to stop and they want to go for sales growth again? The fact that Jeff Bezos is no longer, actively involved, maybe that means that they're going to wind back a little bit on the growth at all costs without any recognition for profits. So sort of three very distinct sort of businesses jammed together, all with different issues. You look at it, the glass can be half full or half empty, depending upon how you want to look at that one. And so, it's but certainly the Amazon Web Services part of that business is growing really quickly, which is why I think the company itself is thought upon as very much being part of this Magnificent Seven. Did I get all seven?
Yeah, I think you did. Tick them all off. Okay, so here's a question. There are a lot of index stocks, right? And a lot of people who are trading the index. The index is getting more and more distorted by this small group of stocks. So what does that do to risk? And what does it do to the relative performance of index stocks versus non-index stocks?
Yeah, so a couple of, well, first of all, it's been if you've been invested in the big companies, you've done much better than if you've invested in the small companies. So that's very clear. As an index, so when a stock in an index goes up, the index itself doesn't need to buy more of it. So let's say every other stock stayed the same and Amazon doubled tomorrow. So if for somebody who's holding the index, well, you already had Amazon and it just doubled. So now it's twice part of your index as well. And so it hasn't actually changed. You haven't need to buy any more. But anyone who needs to buy into your index now needs to buy more Amazon. So anyone sort of chasing that. So on the head level indexes, it doesn't cause as much of a distinction as you might think. Having said that, there's definitely some sort of niche indices around the place where sometimes it does make a difference, whether particular companies end up in value indexes and then they leave those indexes and it causes an issue, or whatever the flavor of the month, a growth index or a momentum index. And sometimes it can be multiple different versions of indexes or strategies. And then something happens and it has a big profit warning, and all of a sudden it drops out of, a value index because its profits no longer fit, and it drops out of growth index because the growth doesn't matter. And then it sort of drops out of a momentum index because the stock starts going down, and it also pushes, can make some more volatility. Definitely add volatility at the individual level. So I think we're 25% ish of the index that these seven stocks. The S&P. Actually, having said that, I haven't double checked that number, but I think it's ballpark that. Compared to Australia, that's not that bad. Australia is much more concentrated. So, these guys are talking about how bad it is. It's so concentrated, and we're like, 4 banks and BHP, and all of a sudden, you've taken out 30% of our market index almost. And so, it's all relative. It's all relative, and it's an argument I've used a lot. I've probably said it on here a few times. Is if I was a financial planner in the US or an asset manager in the US, and I told people I'm going to fill their portfolio with, 50% banks and resources. If I got that wrong, I'm losing my job or getting sued by clients, because it's crazy. Why would you stick so much of your money in those two sectors? Whereas every Australian investor who's investing in the ASX, 100 or the ASX 200, that's what they're getting, a portfolio full of banks and resources. And so, And so actually, I'll come back to that as well when we talk income later on. was worth.
Okay.
Yeah.
No, good. Now, Cookie asked a really interesting question, right? Which is, are the current markets real, or is it a game of chicken? And if there was a big crash coming tomorrow, which sectors are crash proof? And that's an interesting discussion, because some people are now saying, well, maybe we should be looking at sectors that effectively have been underrated recently relative to the tech sector. I'm fascinated by the different opinions that are out there, because there are some still saying, no, the tech sector's got plenty more runs on the board to go, despite the fact that, as you said, a lot of them are actually, making stuff and then others are buying them. So it's a bit of a circular argument, right? A mutually reinforcing positive, which could go negative. But what about other sectors?
Yeah.
How do you think about it?
Yeah. So look, there's definitely, the big take I'd be talking about now is it's all about quality companies, what we call quality companies, and think about it as companies that have put their prices up over the last few years and are going to manage to hang on to those, because there's lots of companies who put their prices up who won't hang on to them. And I use car makers, but you can go through a whole bunch of other ones, tire manufacturers, transport companies. All these people have got, pretty commodity-like products, or products that aren't, or they've got lots of competition in them. And so, let's use a transport as a good example. You're shipping stuff from Asia to the US. You're running out of room, so you can start charging $10,000 for it. And you used to charge $1,000 or $1,500, and so prices ran all the way up, and then prices ran all the way back down again as this flood of new boats and all the supply stuff freed up. So you just don't have the pricing power to hang on to it. Car manufacturers spoke a lot about more discipline and, we're not going to make the same mistakes as before. We got all these great gains because nobody could make enough cars. And so car prices went high because people still wanted to buy them, but nobody could make enough. And all the car companies are talking like, we're never going to go back to the old days. We're going back to the old days. And then China's a great example. They're pumping out as many EVs as they possibly can. And that'll push, they'll keep producing cars until they push prices down. And so, so those are the industries you don't want to be in. The ones where, like a Microsoft, for example, where you're like, okay, they put up the price of the Office and they put up the price of, other software, some of these SQL servers and other bits and pieces they're selling in the background. Can they hang on to those price rises? Yeah, they don't really have competitors, and people make these, pretty big decisions in terms of what they're deciding. It's maybe they won't be able to push through as many price rises, but they're unlikely to have to give back those, the price rises they've seen. And so that's very much where we're looking, is to try to find, companies that we think, and in a Warren Buffett terminology, it's companies with an economic moat or whatever it is, or a monopoly position or an oligopoly position where you think they can hold on to those prices. And that's where, in Australia, you look at what we're talking about for the big grocery companies, and have they been gouging on profits? Well, I won't preempt that, but we've certainly been buying some of those as part of our quality themes. And so the question is, will the government force them to give back by pressure on that, or will they just not put prices up as much over the next little while? And so, it's sort of an open question. So quality companies is one place. Then you want to start looking through and saying, what are the, if you're worried about, talking about if you're worried about a crash, what are the income and the income type stocks, the more stable utilities and stocks like that, defensive stocks, what are the ones that will manage to hold up? So, for example, if you're in commercial property, well, that could be the epicenter of the problem. So you probably don't want to, traditionally, that might be one area where you'd say that, I want to try and get properties, I want to try and get properties stocks to help cushion the down blow. But yeah, if you pick up the wrong sector, that's you'll be in trouble. So we're looking more at other defensives, whether it be some of the utilities, pipelines and things like that, where if things start falling, you'll see a yield pick up in some of those ones. And then it's a question about growth. So some of the stocks we're looking at, certainly ones involved in cloud computing, artificial intelligence. We've got a bunch of ones that we've sort of, one of our themes is onshoring. So there's a bunch of companies that are involved in robotics manufacturers and service companies that are sort of benefiting as new money. It's sort of, some of it's money moving out of China, stuff moving out of China and into other countries. A lot of it's more about saying as factories are reaching their end in China, they're being the new ones are being started in other countries. So it's a long sort of slow process. The energy sector is another place where we find that a similar type of thing on terms of service companies. So we're looking for growth. So we're looking for service companies in the energy sector, more about the ones that are regardless of whether you think nuclear power is going to be the winner or batteries or solar power or wind or whatever it is, it's going to be or gas-fired plants, whatever you think is going to be the winner. The reality is our energy system's changing, and somebody needs to do the plugging in and the switching and and building of new transmission and all that type of stuff. And they're the companies we've been trying to invest in. Obesity drugs, another big one. I do think that's so these are, and this sort of flowing back, I'm sort of starting to morph into, this is flowing back into some of the reasons why over the next 5 years, I can see quite a positive economic environment. The big themes, some of those same ones I've spoken about, but obesity drugs, if you can we've spoken before in the past on this program about it, but basically the idea is they seem to work really well. The side effects seem to be pretty minimal. If you can take the most overweight 10% of people and bring them down in weight, that gets rid of a lot of medical problems. There's a lot of diseases that are all sort of based, that all, if you weigh less, are much more helpful for you. So that could be a huge productivity gain, extra lifespan for people. So that's sort of one thing coming over the next 5 years. All the AI stuff, I think that's a big productivity gains. There's probably some social issues we should talk about later, but in terms of company profitability, they'll be able to do more with fewer people. And then your other one is your electricity side, which is a lot of the solar battery, wind, all just keeps declining in price. And that's reaching a level now where it's pretty close to parity. Even solar plus battery is getting close to parity with a lot of these other technologies. And that basically means that puts a lid on energy prices. You just can't see, besides sort of short-term spikes, we can see that energy prices are sort of going to be, over the next 5 to 10 years, sort of falling away. And then the driverless cars and, that's sort of an AI type thing as well, that potentially that's hard to say whether it's going to hit. It does, Google's doing some pretty impressive stuff in recent months. It looks like it might, could that be a theme over the next 5 years? Quite possibly. All those could cause a lot of social disruption, but all could be quite positive for productivity and earnings. And so the question then comes back to, we've got weak earnings over the next year to 18 months. Can the market look through that? And 6 months ago, my answer was very much no. I didn't think they could look through it. I'm less convinced of that answer, mainly because this past reporting season we saw forecasts got cut in half in terms of we went from 10% growth to 5% growth in the course of a month and a half, and the market rallied through it. And so the question is, well, if the market can sort of ignore the weak earnings for a year to 18 months, and then you start getting these productivity gains on the other side, then waiting for the ideal time to get in, you might not see it. And it's a good argument for why, as I've spoken before in the past, is you don't want to be 0 or 1. It's a question about, if I need some sort of exposure to themes and markets, whether it's stock markets or bond markets or whatever it is, because you can be wrong or things can surprise you, or the market can just ignore factors for long periods of time. And if it looks over this earnings gap and looks over this slowdown that we could see, then maybe there's a reason why you might not get a chance to get in. The flip side argument is that you will get a big earnings downgrade, or you'll get a commercial property crash, or one of a half a dozen other things that could happen and could give you that entry point. So so it's a question about not being a 0 or 1. This.
Yeah, and the point is, of course, you need to be invested, and the question is, what is the right formulation for the investment, taking the risk and the returns? And the fact that diversification is probably a good thing. As you made the point earlier on, and I think it's just worth underscoring, there isn't a lot of diversification in the Australian market, right? So just bear that in mind. And I guess the other question is, we had a situation where the returns from term deposits and things were actually quite high. You could get 5% plus. That is not going to go on forever, is it? Interest rates are definitely at some point going to ease back. And we're already seeing some reduction in some of those, if you like, easy returns. So the question is, if you're an income investor, how do you think about it now?
Yeah, and that's a very good point. The big thing for me for an income investors is it's about minimizing your risk. I mean, it's almost by definition that if you're an income investor, you care about making sure you're getting those dividends and interest payments coming through. And the thing I would caution, even if you had a pretty rosy outlook about the economy and you thought inflation was going to get away from you and all these things like that, so interest rates would remain high. If you are an income investor, your risk is that you get that wrong and they don't remain high, and you go back to that period we saw, over the last 5 or 10 years where, maybe over from 12, say, through to 2020, where we just saw interest rates fall and fall and fall and fall the whole time. And so, we effectively reached zero in terms of, what you're getting out of your bank. So you can lock in now. And I guess this is one of the points we've been making, is that bond yields are not too bad. You can still, they have come in over the last, I don't know, 3 or 4 months, I guess. And they've spiked up and down a little bit recently, but you can sort of get, I'll bring up the screen if you want. This is a sort of what you can get on the one through to 20-year rates. You can sort of get 4.5% if you want to stick your money away for 20 years. And and I sometimes speak to people who that's what they want. They're just like, yeah, you know what, 4.5% will do me. That's all I need. I don't have to worry about anything. I can just stick the money in there and forget about it. And it's worth thinking about, or at least how much of your money you want in these different rates. So you can lock that money away for a long time. Gives you an option to sell if rates do come down, then these bonds will be worth more, and you'll get that option to sell. But it is a factor that people should be thinking about as to what's the income you can lock in. And so that's what you can get from bonds. Cash in the bank is your I've sort of got here, what you get on TDs versus cash management accounts and online savings and things like that. It's actually relatively variable at the moment. So, the cash management accounts in particular are still paying really low interest rates at the moment. And even your online savings accounts are sort of, more like 2%, is what the RBA is sort of seeing as their average. So, have a look around, I guess, is an important thing. At the moment, but interest rates are certainly low, and they're volatile, obviously, as well. That's where you can get really caught. It is worth thinking about dividends on. Actually, the other one worth noting as well is inflation-linked bonds. So these are ones which not a lot of people buy, but for anyone who is worried about inflation and particularly their own purchasing power. These are really, these are interesting in that you effectively, I've got a chart up which might help explain it, hopefully, which is basically sort of showing that you pay out this thing to buy these inflation-linked bonds, and then you start getting paid interest payments, and the interest payments go up every year or every quarter at the rate of inflation. So you get that increase, and then when they give you your money back, that also has the rate of inflation on it. So the issue is the interest payments aren't that high. So you're probably only getting 1% to 2% in terms of your interest payments at the moment, but they're increasing at the rate of inflation. And at the end of it, you're going to, you put $100 in, you'll get back in 10 years' time your $100 plus any inflation that you've seen over that time frame as well. So for quite conservative people, or even just even if it's just as a proportion of your portfolio, it sort of makes a lot of sense. And then the final part's dividends, which on Aussie stocks, Sorry, I'll put that away at the moment. So on Aussie stocks, you can sort of get maybe 4.5 to 5% at the moment, and a lot of that would be franked. Now that's across everything. The big issue with that is it's a lot of it's banks and resources, and so internationally, on a broader portfolio is closer to 2%. So it's about so you're getting a much lower yield. But the thing is, about more than half that difference comes about because of the asset allocation in Australia. So basically, if you looked overseas and you said, "Oh, I'm going to buy 60% banks and resources overseas," you'll get a dividend yield much closer to the Aussie dividend yield. So I guess what I'm saying is the lower yield, the higher yield in Australia is mostly an asset allocation decision to invest lots in resources and banks. And then the other thing to note as well is with international shares is that you do actually get a sort of equivalency in terms of franking. It's most of them have got some foreign tax paid on them, sorry, not most, a lot have got foreign tax paid on them. And so while it's certainly not as good as franking, you get back money even if you haven't paid the tax. It is tax that's been paid for you, and you do have lower tax. It's better, a dollar of a dividend through with foreign tax withheld is more tax advantage than say a dollar of interest you got in the bank. So yeah, lots of different ways, and it is worth noting that in terms of dividends, they are pretty steady. So I've got a chart just sort of showing this is the total dividends that get paid in the US for the S&P. So around the financial crisis, you had about a 20% fall in the amount of dividends, but you can see over that sort of red line just sort of showing that 4-quarter average, it's pretty consistent in terms of the rise, and there's not a lot of downtime. So you had a 20% fall in that 2008 crisis. You had less than a 10% fall, probably more like a 5% fall around COVID. So yeah, and that's sort of different to dividend buybacks that sort of come through, and that sort of helps to increase your dividends. But sorry, stock buybacks, and they're sort of a lot more volatile in the US. And I sort of think about Australia as being doesn't do anywhere near as many buybacks, and so the dividends are a little bit more volatile that you see in Australia, and also the fact that you leverage to the banks and resources. Yeah.
And just on the dividend returns in Australia relative to the US, I was looking at some data the other day suggesting that the US has been consistently better in terms of average performance over the last couple of decades relative to Australia, just in terms of the dividends. Is that what you see as well, or is it sector dependent?
In terms of dividend growth, absolutely. So, and I think that one of those charts I had up there was just showing once Australia put in dividend imputation, all of a sudden Australian companies started paying out a lot more. Yep. And now when you adjust the numbers, Australian companies pay out roughly the same as international companies. Some years it's above, some years it's below, if you count both dividends and buybacks. And so effectively what's happening is a company goes, okay, I've got $100 million spare, I'm going to give it back to shareholders. In Australia, they'll go, well, I'll pay most of that out as a dividend, and maybe I'll do a small buyback. In the US, they go, we'll pay a small amount out as a dividend, and we'll do the rest as a buyback, which will mean that the dividends forever, because we're basically wiping out, whatever it is, 3% of shareholders. Well, everyone else is going to, because those shareholders are gone next year, everyone's going to get dividends that are 3% higher because we've wiped out 3% of shareholders, and there's just fewer people left to split the dividends. And so, so when you take that into account, the US looks way better on that basis in terms of that growth in dividends.
So what does that say then in terms of international exposure versus domestic exposure? Because obviously there's an exchange rate risk as well, which is something to bear in mind.
Yep.
But if you were thinking about relatively long-term performance, presumably the US is a better market than Australia.
Yeah. Now, so let me talk global as well. So and think about when I talk global, I mean the big companies are multinational, almost Almost always. So if I've got the top. My universe we invest in is the top 1,500 stocks roughly. It's called the MSCI World. It's about the top 60 odd in Australia, and most of the companies you're getting, if you're buying a McDonald's or a Unilever or Apple or something like that, they're not just a US company. Yeah, they might be listed in the US, but they're Unilever I don't think is. Sorry, it's a UK one, but their businesses are everywhere, right around the world, and so the earnings from the currency perspective is sort of adjusted from that perspective. So there's two main things I want to talk about though for an Australian investor investing overseas. One is that the currency usually acts as a bit of a shock absorber. So we've seen in the last couple of crises that we saw, when you see big downturns in markets, so markets fall 10, 20%, the Aussie dollar typically falls as well. And what that does is that actually cushions the blow. And so, my US dollar terms, I might have been down 20%, but because the Aussie dollar fell 10% at the same time, I've actually only lost 10%. I've only lost half that amount. So that's one factor for it. And the other factor to remember is, if you're investing because you want to, or most people are investing because they want to fund future purchases, things that they're going to be doing in the future. Now, you go through and you look at what you buy and you go, okay, well, my house and everything like that is pretty much Australia and Australian costs. There's not a lot that sort of comes from international costs. That's one big thing. You go through sort of some education and medical services and things like that, and a lot of that's all Australian based. Then you start getting into other stuff that you're doing, and a lot of people are going to have streaming services that are probably from overseas, and movies that are mostly made overseas. And then you've got phones that are all made overseas, and you've got cars that are all made overseas. And so you go through all these things, and so it's just from a spending point of view, it's worth thinking about having that cushion for what you're spending. But you want to go on holidays, you want to be in the position where the Aussie dollar does fall. Well, I've got some international stocks. They've gone up in value because the Aussie dollar's fallen. I can take my holiday and I don't have to worry as much about actually, if you enjoy doing overseas holidays and you're only investing in Aussie stocks, then maybe for a couple of years you might have to lighten off or skip it for a year or two. So so it's all about that diversified portfolio and trying to match a bit, your cost to cost of living to your to what you're investing in as well.
Yeah, and there was always a long-term view that as you move into older age, as it were, you probably want more of a sort of a lower risk, more fixed returns. So the bonds versus stocks. But other people always say, well, you want 40-60. I feel those sort of old rules of thumb are a little bit out of date now. Yeah.
Well, and certainly the correlation between stocks and bonds is sort of, there's some questions over that. One of the things, I worked for a brokerage firm and an Australian broker at one point, and we had a relatively good view on international, and it was, at the time, it was the right call. This is a decade or so ago, and I used to get a lot of flack from the people who were like saying, stop telling people to buy international. We sell Australian stocks, and that's what. So you should be telling them to buy Australian stocks. And that's that. It's that part of the thing when you look at in Australia 20, 30 years ago, when the asset allocation used to be, you got to own mostly Australian stocks and you can have a little bit of international. But now that it's actually much easier to buy international, as it's become easier and easier, all of a sudden people have been like, okay, actually maybe we should need more media. And I think the conventional wisdom's gone from having a very small amount of international and mostly Australia to now more than 50% international. And as a sort of default holding within a portfolio. And so that's what most of the professional investors are doing, but it probably hasn't filtered through to all investors yet. And there's lots of it's much easier. I mean, ironically, we recently launched on within the last year or so, we launched on a platform called Interactive Brokers, one of the world's largest brokerage firms that does have Australian operations as well. And so we trade. We sort of bundle up trades to bring down costs for clients as we do that. And they've got quite a complicated pricing structure, but ironically, it costs us way more to buy Australian stocks than what it does to buy international. It would be US would cost us, I don't know, 20% of the cost that it cost us to buy Australian stocks. So yeah, it's just sort of, it's interesting that it's getting so much easier to do that as now.
And I guess also that, there's greater transparency and visibility now with, well, at least on some platforms, to be able to see what's going on more readily. Because it always used to be, a few decades ago, where you chuck some money over the fence and somebody would be looking after it for you, and you don't really know much about it.
See what's going on.
They might or might not provide you some useful information at the end of the year. That has really started to change. Although I would have to say, not universally so. There are still some very opaque sectors of the market, and I quite often are interested that people, prefer to look the other way and say, well, it's somebody else looking after it, I don't need to worry. I would say, well, maybe that's not the best strategy these days.
Yeah, well, and that's actually, that does come back, especially when you're buying international stocks. There's a number of places out there now that do free trading for US stocks. I'd be looking very closely at what you're paying for currency exchange, because a lot of those, there's a few of them that charge eye-watering currency exchanges, and so you're like, yeah, I've just bought $100 worth of stock, and they didn't charge me any commission on it, and they're like, yes, but they screwed you by 3% on the currency conversion or something like that, and so you've paid for it. You just haven't noticed where you paid for it, and so yeah, transparency is very important.
Absolutely. Well, I think more than ever, and particularly when you actually look at the fees and the way that the fees are actually slipped out, sometimes without really being very transparent as well. It's good to understand, because I'm surprised, and you can run a model to show the difference between 1% and 1.5% of fees being taken out annually on a portfolio over 20 years. The end game, in terms of the difference of outcome, is huge.
Yeah, absolutely, and so. Yeah, and so I think we're sort of working on a few things at the moment to sort of bring lower costs, and we've got a couple of platforms which we're literally just writing up some stuff for clients today about it, is in terms of how we can sort of bring these costs down, because there's certainly some of the older players are happy to keep them high, and this is the way they used to do it, and so. Yeah, trying to try and hang on to that as much as possible, or hide stuff in opaqueness. As I said, it's hide where the actual fees are being charged. I mean, there's certainly there's superannuation funds out there that talk about having low fees, and then you look at sort of the statements, and quite clearly you catch that actually their administration fees are quite low. But they've sort of gone, they haven't shown you the investment fees, or they haven't shown you these other ones. And when you add in these others, all of a sudden they're much, much higher than what the headline rates. So yeah.
No, in some areas of the market, it's pretty opaque still. And they don't, I'm surprised, but they don't seem to have an obligation to tell the whole truth and nothing but the truth.
No, that's right. And ETFs are quite often a good example of ones where people will say, oh, we're charging you whatever, 0.5% to manage your money, and that's the admin fee and the platform fee and all that sort of stuff like that. And you're like, oh, great, that seems relatively reasonable. And then but what they haven't disclosed is they've bought a bunch of exchange traded funds, and some of them might be related to the issuers, and some of them might have quite high fees on them. Some might be paying, 0.5%, 1% on some of the exchange traded funds within it. But because they're bundled into a product, they don't split them out, so that they're just hiding the fact that there are layers and layers of fees within it.
Yeah, very interesting. Now, of course, some of the news this year is related to Bitcoin. Of course, Bitcoin has gone up, but one of the interesting things is the spot ETF in the US, and
Yes.
be interested in your reaction to that. I mean, I've always of the view that Bitcoin is an interesting but rather speculative corner of the market, and you wouldn't want to put all of your savings there. But somebody's asked, do you have an ETF or a fund based on Bitcoin?
Bitcoin.
Any thoughts?
No. I find the irony is not lost on me. Let's put it that way. Is that you've got this thing which is the future of payment systems, and what's caused it to rally from 20,000 to 50,000 is the fact that I no longer have to actually use the real Bitcoin system to buy it. I can buy it through an exchange traded fund.
Yep.
I can use the old financial system to buy this new thing. And so I don't actually have to go near Bitcoin myself. So therefore it's much more attractive. They don't have to. Isn't there a circular reference in there somewhere? Yeah.
Well, two observations. The first is, of course, the way that it's being done in the US is they're actually getting a spot price off effectively a particular sector of the market, right? So it's not really, to be able to actually mark to market. But the other is that if you look at where the ETF makes their money, going back to your point about there are fees now within the ETF structure, which means that those large financial institutions are again milking the markets just as they did in the old days. So this is actually where you've got, the sporty Bitcoin outside the financial system, completely untouched by the financial system, now completely contaminated by being within the financial system.
Yeah. Yes. Well, and that's there's a SPIVA, it's called, the S&P something IVA. I can't remember what the acronym stands for. They keep coming out with these reports, and I find them interesting. But they're always saying active managers underperform. Is their whole mantra is active managers underperform, and they keep going over and over again with that active managers. And then, but the bit I don't. And then when you dig into other ones you dig in more deeply, and you go, okay, well, what do retail investors do? And you go, well, retail investors really underperform. They underperform by about 2%, and most of it is because most of the reason why retail investors underperform is because they buy in at the top and they sell out at the bottom. So it's mainly market timing. Some of it's paying too much in fees, but it's mainly market timing that gets it wrong. And so you go, well, passive funds I know underperform because they give you the average and then minus whatever the fees are, and the fees might not be much, but they do deduct that. I know retail investors underperform, and then Spiva's telling me that professional investors underperform. Like, everyone's on one side of the boat. Somebody must be, you can't have an average. Everyone's below average. Somebody must be above average. And the net effect, in my view, when you dig through all the research and you look at it, is actually that no, professional investors do make money and they do outperform, but a lot of them then take all that outperformance in the cost of fees. And so, especially if you're getting some people who are getting some big performance fees and playing 2 and 20 and things like that, it's like, yes, I've outperformed by 2%, and then they've taken it all back plus more in fees. And so, so the thing for me is about saying, well, either take out passive investments and at relatively low fees, or active managers that have got reasonable fees and aren't going to take all the performance themselves back in the fees.
And I just wanted to pass one question back to you, because last week I did a show with a crypto enthusiast, and he was talking about the fact that if you look at the Bitcoin chart over the last few years, here it is, right? It's all over the place, up, down, but he says no. What you need to do is you need to look at it in log, because if you look at it in log, then it doesn't look as bad. And he says that's the way you should look at it. Now, I had great difficulty, I must say, in being convinced that just changing the scale on a chart fundamentally changes the philosophy of the stock. Am I missing something?
Yeah, well, look, over longer periods of time, I do like to look at log charts because it gets rid of some of the compounding issues. When I'm looking at a 5-year chart, though, that's not an issue. It's not your, if you're looking at a 50-year chart, you're like, okay, now, if I started with 100, if I went from 100 to 200, and then back, and then eventually the thing ended up at 10,000, that first going from 100 to 200 and back again, that sort of doubling and halving, you lose it in that actually that was a really big move. So I'm using log charts for exactly the opposite reason, if you know what I mean. Like, I'm using log charts because I'm looking, when I look back 20 years, I want to know that was a big move. And it's just that we're 20 years on and it no longer looks like a big move.
Right.
Whereas I feel like he's using it for the opposite reason, which is to say, let's take the big moves recently and try and pretend that they're not big moves.
Yeah.
Well, look, I think that one of the things, one of the times when I realized that actually this Bitcoin is going to last longer than what I originally thought was when they all started coming out with all the investment terms. So I feel like this would have been 2018-ish, and all of a sudden it was a all of a sudden they're talking about the correlation to other assets and how you had this part where you could put Bitcoin in a portfolio and it would increase your Sharpe ratios and all this stuff like that, and the risk return and things that sort of sound good at sort of face value, and you could see why they're starting to get the terminology right in terms of the what you needed to do to get the next set of investors to convince to your story. Now that's all gone out the window because they're just a risk asset now, which is a leveraged risk asset. So they're the better of more than one. So basically, when markets are falling, they fall by more, and when markets are rising, they rise by more. So I think there's it's certainly a volatile asset. I'm not going to pretend that I can tell you when. I can tell you exactly when you need to get in. You need to get in before other people get in, and you need to get out before other people get out. That's you got to beat everyone else to the punch. Whatever everyone else is going to do. Just do it before them.
Right. And let me just underscore, because Nucleus Wealth has a very important philosophy, right? There is a heart of investing, and there's a bit of fuzziness around the edge that you can, speculate to accumulate or not, right?
Yep.
You would put, I think, Bitcoin in the outer rim of that rather than actually in the central core, right?
Yeah. I personally wouldn't put it there, but anyone who wants it, I'd tell them to put it in that outside range. Very much. I want a core of assets that are stable, liquid. Things go wrong, you can sell them. They're the high quality assets, whether government bonds or your blue chip stocks. They're the ones that sort of are going to give you that safer and more boring return, and very much with that idea that when things go wrong. Let's take some of the unlisted property trusts, which is another sort of option, I guess, for people who are looking for income. Is you get the unlisted property trusts, and we saw in the financial crisis when things went long, they stopped paying dividends and they locked up and they said, well, yeah, we're going to sell the properties, but you're going to have to wait 3 or 4 years to get your money back. Now, if you're a long-term investor, maybe that's fine. You don't mind as much. But if you're somebody who was relying on that for income and that was your nest egg and if the income wasn't there, you wanted to sell a little bit and you can't because these things are locked up, that's where it becomes unacceptable. And so what I'm saying is you want the assets that are the high quality and liquid that, you need them. Something happens. It's not a matter of saying, well, somebody's got a medical problem and no, you just have to wait a couple of years until my fund unlocks before I can afford to help you with that type of stuff. And so, but then around that, sure, have different ones and the more diversification you can have and things like that certainly helps. But what we're trying to do is that middle section for you. And for some people, that's 80 or 90% of what they have. And for other people, that's 20 or 30%. But it should be something, whether it's with us or with somebody else, you should have something in that sort of core part of your portfolio.
Now, Cookie Boy asked this interesting question. Thoughts on domestic income funds? Because he's saying that some are paying sort of 8 to 10%. Now, I would say, yes, be a little bit careful on those returns.
Well, reaching for yield. This is always that's what they call it. Is the terminology in the industry is you can you don't want to reach too much for yield. And what they mean is sometimes you can pick up an extra couple of percent, but you end up losing 50% of your capital. And so I made an 8% return for 3 years rather than a 5% return, but all of a sudden the whole thing blew up and I only got half my money back. So it was a waste of time trying to go for that extra money. Now, that's not always the case, and it's actually I'd actually even say most of the time that's not the case. Is most of the time those higher risk ones will end up paying it. It's just that the times when they don't, it's exactly when you don't want it. And it's usually when everything else is falling apart. Your stock market portfolio is going down as well, and so that you can have some problems. So the big question with those income funds is what's in them. It can vary dramatically, and there's a lot of funds in the past that have sort of been sort of mezzanine property funds, and a lot of ones that used to. There's a bunch of ones that sort of I feel like must have been 15, 20 years ago were all done for advertising themselves like a deposit product, and really what they were doing was taking your money and sticking it in giving it to some sort of property developer or something like that, and it's a type of factor where they'd go, yeah, we're paying you 10%, Martin. You can't be upset about that. And you're like, yeah, but you're investing it in something which I should be getting 25% for because you're rolling the dice on, somebody's third mortgage on a property. And so, yeah, so as soon as I see 8 to 10%, I'm always like, well, if it sounds too good to be true, it probably is. And I really need to dig in to find out why they're paying me 8 to 10%. Is it because they're taking on much higher risk? Is it because they're lending to people that just can't get a loan anywhere else? Or is there something, sometimes there's a genuine reason why you can pick it up and it might be worth it. But yeah, that 10% in particular right now would be setting off alarm bells. 8%, I'm like, well, I don't, yeah, depending upon what assets it's in, might be right. But and I mean, look, even 10% might be right as long as you know what the risks you're taking, and that it's not the same as sticking your money in the bank, and it's not the same as buying a government bond. You are taking genuine risk to earn that extra return usually.
Yeah, and again, it's transparency, because quite often what they're actually doing is hidden quite a long way down below the waterline, and you don't really have good insight as to what risk they are really taking to be able to generate those returns. And that's, again, a problem. I think it's a problem more broadly across investing, but I think in these particular ones where they're offering those more attractive returns, you got to put a big question mark around them, because there's a reason why they're able to do that, right? And sometimes the reason isn't a good reason.
Yeah, that's right. And sometimes the mandates are pretty open though as well. They can change.
Yep.
Like you can start with something that sort of seems like it's all right, and then 3 years later they're doing, they've changed fund managers, or they lost a little bit of money and they were trying to make it back, and so they kept on heading up the yield curve, and so is transparency is very important with all these, but even more so with this income part of the portfolio. Like, it's one thing to say, okay, I've taken a flyer on a small cap stock, and I've got $1 million portfolio. I've only put a few grand in it. If it blows up, it blows up. Doesn't really matter. I've taken a bunch of them. But if you're like, no, this is my money I need to live on to pay my rent next week, and I'm getting that 10% return so that I can afford to live. Is like, well, that's where you really need to be careful about, whether that's the right investment for you or not.
Spot on. Well, let's move the conversation forward, because, of course, China is currently having a big huddle about their future economic trajectory. They're sort of holding up their 5% growth target, in terms of GDP return, as still being there, although many people would say that the real returns from a growth perspective in China are quite a lot lower. But it does seem to me as though they are turning the ship away from property and away from some of the old plays, and they're trying to move into a new direction. But there are some consequences, potentially not necessarily positive, vis-a-vis Australian exports.
Yeah. So it's interesting, the 5% target. So there's a couple of different ways they can get there. One way is they can just say they're getting there, and they can just write it up regardless of whatever their result is. They can just sort of massage the numbers to write it up. So that's one way. There's how they've sort of got there in the last little while, in the last couple of years, has been through deflation in a way. Is that they sort of had 3% nominal growth, or 3.5% nominal growth, and 1.5% deflation, and so usually, like if they're running 5% with 3% inflation, well, that's 8% nominal growth. Let me start that again. Yeah, 5% real GDP, 3% inflation gives you 8% real growth, or nominal growth in the world that everyone's actually seeing. That's very different from 5% GDP growth with say 2% deflation, and so you're actually only doing 3% at a nominal level, and especially in a country with lots of debts. If you can grow your income quickly, then those debts sort of fade into the past really quickly. But when it slows down and you start having the nominal, you really care about that nominal growth. So yes, that's one part. Look, it's hard to work out how they're going to do it from what they've announced. So it seems as if there's no new announcements about, we're going to try and reignite a property boom. They're already going hell for leather on all the infrastructure projects. So, and most of those are sort of underutilized, and so it's hard to see where they're going to pick up much there. Maybe there's more they can do on the energy side, but in a way that's they're building new stuff there. Given the demand's not that high, demand growth isn't that high. It's more about saying, well, we're building some new solar or wind or nuclear so that we can shut down some coal. And so, yes, it's a positive, but in a way, you're shutting down coal plants that might have had more life in them anyway. So yeah. The whole idea around switching into higher value goods, that's where they're really running into trouble in terms of the US and Europe, and that's where so much more trade tensions, and we're seeing the US really trying to crack down on what they can push through to China now. So it's going to be a lot more difficult. So whereas when it was all about building, chips, the same chips that we were building 20 years ago, then people were happy to transfer the technology. But then as China's catching up, they're not happy to transfer the technology to build the latest and greatest chips. And so can China make the leap and catch up? It seems unlikely, but and traditionally those high, what do they call it? The sort of the types of projects that rely on cutting edge technology and innovation don't tend to come from government run organizations. They tend more to come from entrepreneurial, or things that are given a lot of scope to come up with entrepreneurial decisions. And the argument I think for a lot of people have had is that the money they've been pouring into say chips for the moment to sort of run down that same line hasn't been giving the results they want, because it's very hard to find innovative companies, suckling at the government teat. They tend to be better, and it also is. It's hard for countries that are saying, Martin, we want you to be innovative and think outside the box. Oh, except about anything political whatsoever. And in that, you have to believe exactly what President Xi tells you. But besides that, we want you to think outside the box. It's hard in countries for people to turn that on and turn that off. So,
and we're seeing some of weakness in terms of iron ore prices, for example. Which,
sorry, that's right. Yeah. I'll get back to that question. Yeah. So I mean, it still doesn't. We spoke before on the last, but I'll repeat it again for anyone. Like if we went back, 2 or 3 years, and you said, okay, China's growth is not going to be that good. They're going to be going through this ongoing property crash. Starts going to be down 70%. But actually, you know what? They're going to be making more solar panels than they ever have before. They're going to have this electric vehicle boom. They're going to be building more transmission lines. They're going to be putting in wind power and all this stuff like that. Now, is copper going up or down, and is iron ore going up or down? And everyone would have gone, well, copper's going to go up, obviously, because they're building all this green stuff, and iron ore's going to go down because there's nothing going on in the property sector, and the reverse has happened. So, my take is that. And actually, one more step before I go into that is that Australia is one of the top producers of a whole bunch of different metals and minerals. But the two that really matter is coal and iron ore. Everything else just pales into the background. Theoretically, gas should sit up there as well, but we collect so little in terms of taxes from it that it sort of doesn't really make as much difference as it should. But yeah, so there's two big, coal and iron ore. So Australia is the largest lithium producer and massive player in that market, but it's such a small proportion relative to iron ore. So that sort of from a big picture macro perspective about what's happening in Australia, what really matters is those two. So iron ore, China uses an incredible amount of the iron ore. Most of it comes from Australia. You would think that this would mean iron ore prices should be lower. I think the long-term prices for iron ore is $50, $60. So, the question about when we'll get there, I don't know. There's a big new mine coming on in Africa, probably in the next I think 2025, maybe 2026, late 2025, early 2026. I think they'll probably start. It probably won't be. It'll take a little while to ramp up, but that's going to make a huge difference. But that's going to be coming on into an already weak iron ore market, in my view. So yeah, it's I don't have a good outlook for that. But having said that, my outlook probably hasn't changed over the last 6 months. And in that meantime, the price went much, much higher and is now coming lower. So feels like the timing's right. But and I do think over the longer term, the iron ore price, companies will still produce iron ore. There's plenty of iron ore around. They're more than happy to produce it at $50 and $60 a ton. They'd love it to be $100 plus a ton, but $50, $60 is going to be enough for them to keep doing and not shutting down and probably produce enough to, if you take into account that whole Chinese housing boom and that finally fading away at some point, that's a more reasonable price for it.
Yeah, well, we'll watch that, I guess, ahead. And as we move into the last part of the show, Cookie threw this question up, which is quite a good way into it. Has the RBA won the war on inflation? And it's interesting. There are a couple of articles come out this week that said rents are still high. The housing sector is driving inflation. We've got wage growth still quite strong. So maybe this inflationary surge that we're seeing is still going to hang around for longer. Plus, of course, we've got higher transportation costs because of the Red Sea. And so maybe the truth of the matter is we are not going to see inflation come back down to target any much sooner than what the RBA said, which is 2025. And therefore, the headroom for cutting rates is probably quite limited this year. Which, of course, until quite recently, both in Australia and overseas, say the US, everyone was expecting significant rate cuts this year. Seems to me they've been kicked down the road a little bit, and the question is the battle over or not for inflation?
Yeah, I think for me, if we get a recession, inflation will disappear. And the question is, where is it really? Because that's a sort of a it's a short-term measure. So inflation always disappears in recession. So it doesn't really tell you whether the underlying inflation levels are still higher or lower. I think the big factors for Australia is a lot of this is self-inflicted and different to what you're seeing in the US. So people are pouring in. We're running at record rates of immigration or close to, which means housing prices are all headed up. That's a bit of an own goal in terms of in terms of that, and not looking like changing. So yeah, so that's one part where we're looking at higher for that. We should have seen almost no change in energy prices. Well, if you pick WA and said, look at what happened to WA energy prices, where they've got gas reservation, all this stuff like that. Not a lot of change. The rest of we're open up to the world. We're seeing all these energy price changes that we just shouldn't have seen, but we did, and they're still so the energy side's a bit of an own goal as well. The insurance side is some of that's a little bit of a delayed impact from the price rises we saw in the past. So there's still a bit to go in terms of that insurance side, but I think when other goods slow down, those will slow down. What else have we got in there in terms of costs? So that's an angle. So, and then the other big one is Australian, because we're bringing in so many people, Australian wages, we haven't seen the same wages growth we've seen elsewhere. So Australia's got this weird part where, the part that everyone was so worried about in the US was, well, wages growth has been really strong. That's going to keep cycling around and cause this wage push cycle and everything like that. We've just never seen it in Australia. It was just never an issue. And so we've got a different looking of inflation than what we're seeing overseas, I guess is my take. I think Australia looks like, from an economic point of view, it looks like it's whereas we came out of the pandemic after everyone else because our lockdown started or finished later. So we came out of the rest of the world, behind the rest of the world in terms of the economic cycle. It's looking increasingly like we've caught the US and probably going to pass it on the downside. So then the question will be, in terms of inflation, well, actually, sorry. Before I get to that part, so there's one risk. There's that risk there. The final part of the inflation puzzle, for me, is a lot of what is actually a lot about this grocery prices and whether we're going to see any decline in those prices. I think the increases are going to be tough to do. But I do think there's a reasonable amount, and it's not just the grocery stores. I do think it's up the line as well. It's the Pepsis and Cokes and everyone like that. For the last year or two, they've been talking about this whole price over volume argument, which is basically that, yeah, look, my volumes are going to be down 3%, but I pushed through a 10% price rise, and so actually I'm going to make a 7% gain in my sales. And so the question is, how much longer can they keep doing that for? And it seems like that's coming to a close. Is there going to have to be a give back at some point? So will you start seeing price wars in some of those? And so that's the part which hasn't really broken out. And you sort of wonder, maybe in the Coke versus Pepsi world, it won't break out. They've got enough of a brand name. They've pushed through their price rises. The fact that you can buy, no name brand Coca-Cola for, a third the price or a quarter of the price of buying Coke, will that make a difference? Probably not. In a recession, it would. It absolutely would. But absent a recession, will it be enough to bring down prices? And then there's just a question about, okay, well that's Coke, which is sort of a relatively high brand item. How much does that flow through to 10,000 other products that you see in the grocery stores that all manage to push prices through? Will they all be as disciplined? And my guess would be no. Is that we'll start seeing some people with high enough quality products come through and decide that actually we're gonna use this as a chance to pick up market share. I mean, that's traditionally the way capitalism works. But that's probably the key part to whether you'll see inflation sort of continue on that front. So that brings us into a recession. Post a recession, it really comes down to government reactions, and I do think that what the government's learned from the pandemic was you throw lots of money at the problem. Yeah, you might have an inflation problem, but people seem pretty happy anyway. And so that's a problem for a few years later, and you're probably not going to be in power at the time. Whereas, a few years ago or 10 years ago, the thing was, oh no, maybe a bit of austerity would be nice. And, we won't throw money at the people and we'll just cut some rates and hopefully that'll sort everything out. Whereas, and so if that's truly what governments have learned, throw lots of money at the problem, then yeah, we will have inflation, another inflation on the other side.
Yeah. Well, I believe helicopter money incoming is we're going to see, I think. But we'll see. And in fact, Jason also made the point, how much of the immigration is skewing the figures. Well, of course, if you look at GDP per capita, it's been negative for a couple of years. Yes. So basically on a per unit basis, we are already in recession. The reason we're not reporting a true recession based on the top level and GDP numbers is just more people, bigger volume, and that's keeping us out of recession.
I think it was there's definitely maybe it's gross disposable income or something like that. There's definitely there's one measure of per capita. There's one measure on a per capita basis. This has been the worst drawdown ever in terms of the amount that we're running backwards. Yeah.
In fact, if you look at real income has gone backwards since about 2010, 2011 for a lot of people. So there's been no real growth in income for a lot of people, other than in particular sectors, or if actually in some of the public sectors, which are doing quite a lot better. So if you look at ACT income growth, it's a lot stronger. Funny that.
Yeah. And probably WA if you measure the right time frame as well with all of the resources money.
Depends.
Well, that's that interesting point though as well in terms of political upheaval is that that type of environment is where you get political upheaval and you get different parties and you get you run through all these different prime ministers and everything like that, and it's for me that's part of the rise of the rise of the Trump was that so many people did so poorly in the US middle income and lower income parts for so long, and the whole time they had to listen to politicians tell them they've never had it better. And you listen to our treasurers tell people about what a fantastic economy. You've never had it so good, and people are like, it doesn't feel that way. And as you said, these per capita figures going backwards, most people don't understand the whole per capita and the whole all this stuff like that. They can't find the statistics, but they do know that it doesn't feel right. And if there's one thing people hate is that them being told everything's great when they know it's not. And so then when you get people like Trump stand up and go, you know what, you're right, you have never had it so bad, and let's make America great again. Next thing you know, you get people following along.
Yeah, and this is interesting because in my surveys, I see quite a lot of people saying, well, the official CPI numbers are way under what I'm actually experiencing personally. So if you look at the growth in prices for the mix of goods and services that they're actually purchasing, it's gone up a lot higher, 3 or 4 times the average annual inflation number. And I think that's another credibility question, right? So, to what extent does the real numbers that people trot out have any meaning or relevance to ordinary people?
Yeah, I know. And I've actually thought as well, I was thinking this the other day, I was looking at some measures and thinking I almost need a bit of a time frame measure on some of these insofar as it's like, well, whatever. It's a car. A car. Well, probably that hasn't happened that much over time. It has. Over time, it's gone down a fair bit. Or buying a new TV. It's cheaper to buy a new TV and everything like this. And it's like, well, yeah, but I don't do that very often. So yeah, the fact that it's down certain amount is an issue. But if I don't buy TVs very often, and it is something I can delay, yeah, I'd like to get a new TV. But if I'm struggling, then I can wait another year before I get a new one, or a new couch, or whatever it is. It's got some deflation in it. But then it's like, well, yeah, but if my grocery bill every week is going up by 10%, but these other things are going down, then yeah, it's definitely something to consider. Is that it's inflation is different for everyone, as you said.
Absolutely. And in fact, if you look at the distribution of inflation across different segments of the community, it's interesting that inflation is higher amongst those with high levels of mortgage stress or rental stress. My latest data shows all-time highs. Right. Other sectors of the community where, in fact, they've got more discretionary spending, the inflation is a lot lower because they're not caught the same way. So again, I'm not sure that the official reporting necessarily helps, but of course the RBA is driven off the official numbers. Although go on.
I was just going to say there's some weird ones as well now. There's some weird ones in like the US at the moment where they impute the value of utilities into rents, and so because the utility costs are going down, therefore rents are going up more than what they should, or whatever. There's some weird things in that where, and to be fair to the people who are putting them together, they're generally not trying to trick people. They're often just, these are very hard problems they're trying to deal with, and they're trying to say, well, okay, I've just bought a fridge. The fridge is, the same cost as what I paid 3 years ago, but actually it's much more efficient now, or it's bigger, or it's got connected to the internet. Well, okay, it's the same cost, but it's better. Does that mean that the price has gone down, or does that mean? And so yeah, there's all these other factors that sort of come into it, and they're trying, but it's not a there's stuff in there that is not what you think it is.
Yeah, spot on. And I did a show the other day showing that in fact the reweightings that they did recently, which is reflected in the CPI numbers, lifted the proportion to do with travel, both overseas and domestic, right? Now, if you look at who's actually traveling, it's not those with stress, it's not those with rental stress or mortgage stress, it's others. So what they actually did is they detuned the housing component in the inflation number. And if you ask most people about what's causing me the biggest grief, it's the cost of housing, whether you're in the rental sector or whether you've got a mortgage.
It's not that my flight to the US for my annual Aspen trip is gone up. Yes,
no, exactly right. Well, Damien, we've pretty much got to the end of the show. Once again, as always, really thank you very much for sharing your thoughts with us. If people want to find out more about what you do, what's the best place to
put a quick plug as well in? So we've got our website and the Walk the World Fund, but we're actually going to be presenting at a direct indexing conference coming up in Melbourne and Sydney. Melbourne on the 18th, Sydney on the 21st. They're both in the afternoon. So if you go to the Nucleus, if you go to the Nucleus Wealth site or the IMAP site, you can sign yourself up for a ticket. And they're free entry into these ones. So we'd love to see people there. And direct indexing is this idea around. As part of what we do our active side, but we also do the passive side. And the idea is that you pick an index, say it's a global index, and you say, I'll take 50 stocks or 75 stocks or whatever your number is. And then I want you to add in a bit more cloud computing and a bit more cybersecurity. And I want you to take out gambling and take out climate change, or add some nuclear power in, or take out nuclear, depending upon what your bent is. So it's the idea that direct indexing is sort of this next level where you got the low fees, you've got the index funds, but you can then tilt it or change it to the types of stocks that you actually genuinely want to buy.
Yeah, terrific. And in fact, you have a bit of a fan. Fraser has said, I've looked at Damien's investment products. They are very unique. He deserves support. Well, I agree with that. One of the reasons why we've got the tie-up with what I do here is because, having looked across the market, I felt that what the world is trying to do was very much aligned with Damien's philosophy, which is openness, transparency, choices and options. And the point is, you've got lots of different ways of engaging with investing, from relatively hands-off through very much hands-on. And Damien's built, I think, a relatively sophisticated and actually quite unique set of products and services. So I agree with what Fraser said there.
Your support is appreciated, Martin. Yes.
Excellent. Thank you very much. Well, as always, really appreciate your time today. We'll do it again in about a month. Just to explain to everybody, we used to do it around the RBA monthly outturn, but of course they've shifted their goalposts. But we're going to keep this roughly.
Yeah, that's right. Rather than go to every 6 weeks, we've decided to keep it.
We'll keep going. So we'll do it again. Thank you very much, Damien. Really appreciate your thoughts and insights, and look forward to doing it all again next month. And I'm going to take you offline now. Take care. And just to say that next week it'll be just me, and what I'll be doing there is going through our latest financial modeling and stress. I made a show the other day. We'll be able to look at some of the latest detailed information. So mark your diaries for that, and give you a last view of the dogs, who have not moved the whole of the time, so there they are, still snoozing merrily. Meteor decided to stretch, so just to show you that she is actually still alive. She's not stuffed. So thank you very much for spending some time with us this evening. Hope you enjoyed it. Hope you found it insightful. And I'll look forward to seeing you on the next live show next week, or indeed check out our recorded shows. They come out each day, and we cover finance, property, and related issues. So look forward to seeing some of those with some good views. Please like, subscribe, and share our posts. And I'll look forward to seeing you next week. This is Martin North from Digital Finance Analytics, signing off. Cheerio.